Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. It's week 2, recorded live at the Real Estate Guys 22nd Annual Investor Summit at Sea. Great faculty members last week, more faculty members this week. Tom Wheelwright, Brad Sumrok, Jason Hartman, Peter Schiff, and lots more today on the Real Estate Guys radio program. As real estate investors, it's no secret that the Real Estate Guys love Florida, and the Sunshine State continues to receive more than its fair share of businesses and population relocating from the Northeast, which has created a huge opportunity for real estate investors. So come join me in mid-September for our Jacksonville field trip. On this highly interactive trip, you'll get an up-close, hands-on, personal experience you'd be hard-pressed to find elsewhere. You'll feel the vibrancy of the markets, observe the quality of the infrastructure, and truly get a sense of the demographics. All things you just can't do by simply searching online. Plus, we'll introduce you to our boots-on-the-ground team, and you'll meet some amazing investors from all over. To reserve your spot, go to realestateguysradio.com and click Events, then Live and In-Person Events, where you'll find the Jacksonville field trip. There's a big difference between researching a market from afar and seeing it with your own eyes. So join the Real Estate Guys September 13th to 15th as we explore Jacksonville and some surrounding markets. Go to realestateguysradio.com and click Events, where you'll find the Jacksonville field trip. I look forward to seeing you there. Welcome to the Real Estate Guys radio program. It's the 22nd Annual Investor Summit at Sea with a live studio audience. Yeah! Oh my gosh, what a week we've had. We've been learning together. We've been lunching together. We've been drinking together. Some of us have been sleeping together. It's been absolutely amazing. And what an incredible week. Last week on the show, we had our first round of incredible faculty members. This week, oh my gosh, we're not holding any punches. Let's say hello to returning faculty member, CPA Tom Wheelwright, ladies and gentlemen. Tom, welcome back to the summit.
Hey, thanks. It's been an amazing week at the Summit at Sea.
One of the things we always have you do, Tom, and you're so good at this, is introduction to tax, because not everybody is used to thinking of the incredible tax tools that you provide. Most people dread tax. They don't like tax. They don't want to think about tax. But I think you've opened up some minds this week. Share with us some of the light bulbs that have gone on for people.
It's been fascinating. So really, tax is pretty simple. Their tax law is a series of incentives for business owners and certain investors, and particularly real estate investors. And so once you change your mind about what taxes are really for, then you can start asking better questions, like instead of asking, is something deductible, can I make it deductible? How do I reduce my taxes to zero, rather than how do I pay just a little bit less tax? So a lot of it is about long-term strategy, taking a very holistic view of taxes and your whole wealth situation and not being afraid of it.
Now, Tom, your best-selling book, Tax-Free Wealth, everyone in the audience has certainly read the first or maybe the second editions of, but you've just come out with a third edition, and that's because tax law changes.
It does, and what we did was we incorporated a lot of things that we kind of wrote quickly in 2017 when the tax law was changing very rapidly then. And since then, we've had 6 major tax law changes since the 2017 tax law. So we had to incorporate all that into the book. I'm really happy with this version of the book because I actually think it's by far our best, the best edition.
Well, and the other thing about it is tax is something that applies differently to different people based on how they earn their income, where in the world they live, all of those things. So it's really hard to have just a blanket, this is how you do it. And this week, you've been kind enough to sit down with over a dozen summiteers and talk taxes without revealing anything. Just tell us about that experience.
Well, it's been really fun. I've been looking at people's tax returns, which I actually think is kind of fun because it tells so much about a person. I can pretty much tell anything about your financial situation by looking at your tax returns, but it tells me a lot about your advisors too. And what I find is actually there were a lot of mistakes, more mistakes than I would have expected on people's tax returns, and a lot of opportunities to save a lot of tax. I think this week we've saved over $1 million of taxes.
Awesome. Let's have a hand for that. 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 Let's have a hand Tom, you've been with us a bunch of years. Not quite so many years has your wife joined us, but Luann's been with us the whole week, too. You guys have been having fun as well as educating.
Oh, we've had so much fun, particularly on the dance floor. Thank you, Tequila Shooters, for letting us old people dance to music that we actually remember from our high school days. So we've had a lot of fun. We've met a lot of people. We've had dinner every night with a different group. And we particularly noticed just how sharp the young people are at the summit this year. They've been just extraordinary.
That's Tom Wheelwright. Let's give him a hand. Now, I firmly believe that we're going to see at least $1 million saved in this entire group of people, but our next guest saved nearly $1 million on his own tax return when he met Tom Wheelwright. Welcome back, Mr. Brad Sumrok, the apartment king. So, Brad, tell that story, because I remember the first time we met, you were getting close to having $1 million tax bill, and you were excited about it.
Yeah, my first real estate mentor taught me there's 4 types of millionaires. The first type is when you have a net worth of $1 million. So I checked that box. The second type is when you have $1 million liquid, and I checked that box. And then the third type is when you make $1 million in a year, and I checked that box. And then the fourth type, from what he taught me, was when you pay $1 million in tax. And dang, I came so close to making that fourth type of millionaire. Paid $965,000 in taxes in 2017. And then I met Tom Wheelwright. And he said, Brad, I don't ever want you to tell that story again. I started working with Tom and haven't paid federal income tax in 4 years.
How about a hand for that? Because real estate is a great investment vehicle when it comes to the tax incentives we have, but it's not the reason we invest. This week you were able to also do an introductory class teaching people who haven't invested in apartments before about that. But you also, at the beginning of the summit, it seems like weeks ago, you shared with us some of the big picture stuff that's happening. Where are we in the market when it comes to apartments?
Well, we're either at the top of a cycle or in the middle of a cycle or at the bottom of a cycle, right?
You heard it here first.
Yeah, and it occurs to me we're near the bottom of the cycle. And why do I say that? Because in 2022, looking back, you know, we were at an all-time high in terms of prices, and it was a complete seller's market in multifamily. And now we're seeing a lot of the opposite. We're seeing pricing down about 30% across the board in all property classes, A, B, and C, multifamily nationwide. And, you know, we're seeing interest rates have gone up, equity is tighter, debt is tighter, and more people are cautious. And we're also seeing people needing to sell, and we're seeing a lot of distressed assets. And so I haven't seen anything like this since 2008, and I've been in the business since 2002. So it occurs to me that we are near the bottom of a cycle. And so it's go time. It's time to get into multifamily if you're not in it. And it's time to put your foot on the gas if you're already in it.
Well, we did talk about the various types of ways to invest in real estate. We had 2 panels. We had a panel of single-family investors, lots of different ways to invest in single-family. And then we had the multifamily panel. That was awesome. We had you, we had Ken McElroy, we had Randy Hubbs, we had Anton Matley talking about financing. We've heard that the pricing is down in a lot of marketplaces, but demand continues to be strong. What should somebody do to be preparing for the next couple of years?
Well, I think they really want to be, becoming a market expert is critical. So finding markets where the fundamentals are better than the national average. So, for example, one of the things I look at is affordability gap. And what affordability gap is the cost of owning a medium-priced home versus the cost of renting a medium-priced apartment. Nationally, that's about $1,300 a month. And so we're becoming more of a renter nation. But if you could find markets where it's higher than that, then you're going to have tailwinds. Similarly, if you look at markets that have higher than average population growth and job growth, then you're going to have the cards are going to be in your favor. So you want to be the house and set the odds in your favor, and really just becoming a student of like, where are the best markets And then you want to start putting your teams together. This is a team sport, especially if you're going to syndicate a deal. And so you're going to need to have a great accountant that understands real estate, a guy like Tom Wheelwright. You're going to want to have a commercial lender, a commercial insurance provider. And so you're going to want to be building your team and becoming a market expert.
Hey, how about a hand for Brad Sumrok, ladies and gentlemen? You're tuned to the Real Estate Guys radio program. More when we come back.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did. The Real Estate Guys are throwing a party, and you're invited. Join us at the New Orleans Investment Conference, November 20th to 23rd. Now in its 50th year, it's the nation's longest-running investment conference and features some of the biggest names in economics and investing, including James Grant, George Gammon, Danielle DiMartino Booth, Rick Rule, Lynn Alden, and Doug Casey. Plus, I'll be speaking in multiple sessions, attending lots of others. And the Real Estate Guys are hosting our annual invitation-only party one of the evenings for our friends and listeners, including some VIPs for you to mingle with. So make plans today to join the Real Estate Guys at the 50th Annual New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. And I'll see you there.
Hi, this is Anthony Melchiori from Hotel Impossible, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. It's the 22nd Annual Investor Summit. Been hanging out for a week with some awesome folks. Let's meet a couple of the other faculty members. For the last 3 years, this faculty member has not been able to attend live and is the only faculty member we allowed to Zoom in those 3 years. We have him back in the room. Ladies and gentlemen, Peter Schiff. Peter, you brought the whole family, your wife, your kids, your mom.
Yep, 3 generations at the summit.
So you've been kind enough to come in by Zoom to our Summits on the Sand, but tell us about your week here with the Summiteers.
Well, it's been a good week. Unfortunately, I came down with something early on the cruise, so it wasn't as great as it could have been, but I still was able to have some fun and enjoy myself. I know my kids had a lot of fun on the cruise, and got to have some good conversations, and we'll probably be back again next year. So
awesome. Well, hey, why don't you share with us where you think this is all going? You did the great talk the first day about the Fed and how they've already lost the inflation battle. People who are buying groceries and gas have known that for a while, but how is that going to translate to folks that are going to want to borrow money and people that are thinking about investing, whether it's stocks, gold, real estate?
Well, I think as inflation really takes hold and people give up on the idea that it's going away, I think still you have too many people, particularly on Wall Street, that think that the Fed has got this, that, we're going to go back to the days of 2% or sub 2% inflation. In fact, the bond market is convinced. If you look at a yield on a 10-year out to 30-year U.S. Treasury, they're barely above 4%. And so that suggests that the bond market believes that inflation is, coming back down, that the high inflation is just a little bit more transitory than the Fed initially believed. But I think that as you really start to see the numbers moving north on inflation, and they will. And then the economy starts moving south. And now the Fed has got tremendous political pressure to try to stimulate the economy. But the only way the government can stimulate the economy is by creating inflation. And it's never really stimulated the economy. It just helps create the illusion that the economy is growing, because that's part of what inflation does. And so their whole solution to every economic problem was to create inflation. And now that inflation is the main problem, trying to solve problems by creating more inflation is not going to work. In fact, it never worked, but now it's going to have some, profound consequences. So I think that people are going to have to start changing the way they run their lives, their finances, to operate in a world where inflation is high and getting higher. And so, more people are going to want to borrow money with high inflation, but people aren't going to want to lend money. So it's going to be a very difficult environment. I think that the investment landscape is going to change. I think the types of assets that did well in a world of artificially low interest rates and low official inflation, I think that's going to be very different when we're living in a world of high inflation and rising inflation and interest rates that may end up being a lot higher on a nominal level.
Last time we had you on the show, it was the beginning of this year, and there was a lot of talk, people saying, well, you can expect interest rates to go down, and there's going to be 5 or 6 times that the Fed's going to lower the rate. And you said, I don't know if they're going to be able to lower at all. Here we are, and they really haven't. Not that you have a crystal ball, but what would you think going forward? Is it going to be possible for the pivot to happen that we've all been hearing about?
Well, I mean, I think it was already a pivot when they stopped hiking. And it's not a coincidence that the hike stopped when the banking system started to buckle, when you started to see the first bank failures that were the result of the increase in rates. Because when rates were really low, the banks loaded up on overpriced long-term debt, government debt, mortgages. And so as the Fed raised rates, some of the more vulnerable banks began to fold, just like in the mortgage crisis of 2008, you saw the cracks first in subprime. And so the Fed immediately backed off when they saw this, and they had a bailout program that they came up with. But I think over the course of the next several years, a lot more banks are going to be in a lot more trouble. And what happened at Signature Bank and Silicon Valley Bank is going to be happening at banks all over the country. And I think there's going to be a lot of pressure politically on the Fed to lower rates, and they probably will lower rates, if not before the end of this year, but by next year. And of course, when they do that, they're going to pretend that they're doing it, with a victory over inflation, but it's really going to be them surrendering, because inflation won't be near 2%, nor will it be headed that way. It'll be going up. I don't think they'll be able to get away with as many rate cuts as they would like, or as the market might anticipate, because I think inflation and potentially a dollar crisis would get in the way of the Fed's ability to do that. But I do think that the bigger pivot is going to be back to quantitative easing, because I think that that's going to be what they're going to be doing in a big way. I mean, even if they can't bring interest rates to zero, they're going to be cranking up the presses, buying a lot of the treasuries, probably back in the mortgage market again. And who knows, they may even end up in a municipal bond market. They may even be buying corporate bonds. But I think that asset purchase program is going to greatly expand. And of course, that means a lot more inflation, because the only way the Fed can buy that debt is to print the money. But if it doesn't buy the debt, a lot of it is going to crash, go into default. Interest rates across the spectrum will rise, and that would collapse the economy if corporate rates and commercial rates went way up. Let's say they went into double digits. What would happen to the real estate market? What would happen to the stock market if everybody was borrowing at double digits? So in order to prevent that, the Fed might start buying. I mean, even what would happen in the state and municipal level. There's a lot of debt that was taken out by local governments when rates were at zero. Now, they didn't borrow at zero, but they borrowed at 2 and 3 and 4%, which was pretty cheap money. Well, when that stuff comes due, if they have to roll it over at 10%, there's no way they can afford it, and they don't have printing presses like the federal government. But there could be a lot of pressure on the Fed to start monetizing state and local debt as well in order to keep the rates low.
Let's have a hand for Peter Schiff, ladies and gentlemen. All right, let's meet a faculty member who we've known for a long time. We've been hanging out with, but has made it to his very first summit. Ladies and gentlemen, Jason Hartman. Finally, we get you on the ship, Jason.
Well, it's good to be here, Robert. It's just been a fantastic week, a little more than a week, actually, starting at the hotel on land and, the great speakers that were there and all the attendees and with everybody else here on the ship. It's just, I hate to see it come to an end, frankly.
Yeah, this year, you and I taught together the introductory class. The reason we do introductory classes on the summit is that a lot of seasoned, sophisticated investors choose to bring their spouse who may not be up to speed. And also, we've got, as you know, 32 young adults. And so that was a ton of fun getting to teach about real estate. And you've been doing this for folks for a long time, had your podcast nearly 20 years. Talk about where you see the need for investors to help heal the economy.
Yeah, I think investors need to do what's right for them. And ultimately, we are in a rigged system. I completely agree with Peter that inflation is the story of the next decade plus, because that's really their only way out of this tremendous debt and deficit problem, unfunded entitlements. And so the way investors can win is to really just game the system and align their interest with the two most powerful forces the world has ever known, governments and central banks. And to do that, they should take long-term, as cheap as possible, debt against commodities. And my favorite commodity is income property. And if you think of it from a commodity perspective, it's the ingredients of a house. What is a house made of? Well, concrete, lumber, copper wire, petroleum products, glass, steel, energy, labor. All those commodities are increasing in price. And if you can get long-term debt against those commodities, which you can do so well with real estate, you basically take advantage of what I call inflation-induced debt destruction, where you pay it back in cheaper dollars over time.
When people talk about the interest rates and how fast they've gone up and how high they've gone up, most people are thinking in terms of the house they live in. But as you point out, investors don't get emotional. They look at the math, and even though it's harder today, it still is possible in the right markets to get properties that make sense.
Yeah, it is. It is harder than it used to be. Things are not as good as they used to be for sure. But we've still got very low inventory. We should be, if we were considered to be in a normal housing market, we should have around 1.2 million homes for sale. We have about half that now. So inventory is low, but it's especially acute. Those numbers are deceiving because they take into account all geographies and all price ranges. When you look at entry-level housing, which is the housing that we as investors like, there is an acute shortage in entry-level housing. So that really is more and more necessary. And what's interesting about it is you have finally millennials forming households. They are about 6 years behind schedule versus their baby boomer parents. But you have that, but you have people moving up and down the economic ladder. And with entry-level housing, you'll catch them in either direction. And that's why we want to be in that sweet spot with entry-level houses to offer to people.
And it matters where you invest. One of the things over the years that you've been great at is finding markets, being diligent about studying the markets, and you have some techniques of narrowing down of all the places in the world we could invest, some of the markets that are better than others. Can you talk about that?
Yeah, when you talk about the United States, there is no such thing as a national real estate market. There are only local markets. There's about 400 metropolitan areas. There's over 3,100 counties, over 9,000 cities, and according to Obama, 57 states. So I divide these things into three categories: linear, cyclical, and hybrid markets. And what we like, the cyclical, by the way, is the markets that get all the attention. They're the high-flying markets. If you look at a chart of appreciation or depreciation over time, they look like like a roller coaster. We like the linear markets. They're boring. They don't get a lot of attention. They just sort of chug along and appreciate slowly, but they have really good cash flow, which allows you to make these investments sustainable, where you can keep them through any storm. And so linear markets in right-leaning political environments that are landlord friendly. So if you have a tenant that doesn't want to pay, you can get them out and get a tenant that will pay. So those are some of the criteria we like.
And as people are building up their portfolio, then they might consider different markets, bigger properties, their teams get bigger. You've worked with a lot of people that buy their first income property. It's the first time they've had an investment property, but then over time they end up with a portfolio. How would you suggest people approach scaling up when it comes to their portfolio?
Yeah, we have clients that are all over the board that are just beginning investors. We have clients that buy 200 properties through our network. You do this slowly and incrementally depending on your income, the amount of investment capital you have, et cetera, et cetera. But we do recommend that people diversify into at least 3 geographic areas, but not more than 5. I did make the mistake early in my sort of national investor career over 20 years ago in over-diversifying. I had property in 17 states and 11 cities at one point. Do not do that. Okay, it's just too hard to keep track of. But you should be somewhat diversified into at least 3 markets, not more than 5.
Let's give him a hand to Jason Hartman. You're tuned to the Real Estate Guys radio program. We're in the middle of the ocean at the 22nd Annual Investors Summit at Sea.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you're enjoying today's show from the 2024 Investor Summit, make plans to join us next year. Beginning mid-July, we'll open up registration. So to be among the first to get the details, send an email to summit@realestateguysradio.com with the subject Summit 2025. We'll add you to the advanced notice list, and you'll be invited to spend a fun-filled week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. It all takes place next June 20th to 29th, so to get the full details when they're released, send an email to summit@realestateguysradio.com and be among the first to grab your spot and join the Real Estate Guys in an all-star faculty on the 23rd Annual Investors Summit at Sea. Are you achieving everything you want in life? What if there was a time-tested way for you to get anything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, it's Robert Helms. I'd like to personally invite you to attend Create Your Future, the 2025 Goals Retreat, January 17th to 19th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com or call 888-489-7723, extension 18. Get your life back on track, physically, spiritually, and financially. Attend the 2025 Goals Retreat on the 3rd weekend of the new year. Visit goalsretreat.com to learn more and reserve your spot. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723, extension 18 today. goalsretreat.com.
Hello, I'm Herman Cain, and you're listening to the Dynamic Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. It's our second broadcast from the 22nd Annual Investors Summit at Sea. What an amazing 10 days we spent together. Later this month, you'll be able to get signed up for the 23rd Annual Investors Summit and hang out with amazing folks from all over the world. Prior to that, join us at the New Orleans Investment Conference. The 50th annual event is coming up in November. You can get all the details, including getting on the list for our Real Estate Guys Listener Appreciation Party at the New Orleans Conference. by sending an email to New Orleans at realestateguysradio.com. New Orleans at realestateguysradio.com. No real estate trivia or market spotlight again this week, since we're in the middle of the ocean with a live studio audience. Welcome back to the Real Estate Guys radio program, now in our 28th year of broadcast on our 22nd annual Investor Summit at Sea. We have just announced this good-looking group of people, the 23rd annual Investor Summit at Sea. Who's coming back with us? Awesome. Well, on the summit, we love to talk real estate, but we also talk broader picture economics and some other things we invest in. Last week on the program, we talked about oil and gas. This week on the program, let's talk about the precious metals. To kick it off, the editor of the Gold Newsletter, Brien Lundin, ladies and gentlemen.
Thank you.
Welcome back, Brien. What are your big takeaways from the summit this year?
Well, it's always the people here with me. It's such an incredible group of accomplished people, so willing to share what they know about so many topics, so smart. And I know a lot of people have said it as well, but the young adults here just really blew me away. So smart about so many different topics. And these kids are really going to kick it in life. They are just really here to learn, here to act, and I think that's also one of the takeaways around this. Don't hesitate. If I could have started off in my career as young as some of these kids have, my God, where I would have been today. They are just amazing to me and very inspiring.
In your talk this year, you talked about why not only do we need to think about owning gold, but why now? Anyone that's paid attention has seen that gold's gone up in value fairly substantially in the last couple of months. Is it at a top? Could it go higher? You shared some really interesting points of view with us.
Yeah, there's two reasons to buy gold. One is as insurance because it protects against the depreciation of the dollar, something is going to happen. It's not a possibility or a probability. It's something that's inevitable. The other reason is as an investment. When you look at the macroeconomic picture and it's arguing for one of these catch-up periods where people are really worried about the state of the world, financially, the global economy, in particular, the purchasing power of their currencies, they move to gold, and gold tends to have a very rapid catch-up period. And that's the kind of thing we're seeing right now. What's very interesting about this market is that it's the buying is something that we really haven't seen before. Central banks are moving away from the dollar for a number of reasons. They're trying to protect themselves from the weaponization of the dollar that we've seen over the last couple of years. And they're buying gold hand over fist. We're seeing a lot of buying from Asia, particularly China, and that's as the price has been rising. That's something we typically have never seen before. Asian buyers typically buy in price dips, but they are following the price higher and even driving it higher. So it's a unique environment now for gold, and yet we still have not seen the big driver we were expecting, and that being a Fed pivot, which I also believe is inevitable at some point in the months just ahead.
So, Brien, it's almost impossible to talk about gold on a macro level without showing charts and graphs. You showed us quite a few of those, and it's interesting to see those resistance points. When gold was bumping up against 2,000, couldn't seem to get there. You showed us some cases through history when there were a lot of those times. But now that we have kind of barreled through that, what's next? How do you look for where the next support level is? How do we pay attention to what's happening?
Yeah, it gets more interesting because we are literally in uncharted territory. We've set new price records over the past few months for gold. It's starting to behave a little bit more normally now. We're having some corrections and then higher peaks and then another correction at a higher low. We're probably getting into a summer where it's going to trade sideways a bit because that's typically what happens during the summer. But it is literally uncharted territory. So what I do to try to project what the upside potential is, I look at past gold bull markets and see what they did, what the price did during those bull markets. And if you look at the early 1970s, the price of gold went up about 5.6 times from 1970 to 1975. And then it went up about 8 times from 1976 to 1980. It performed similarly in the 2000s, from 2000 to about 2011. So if the price of gold is going to go up 5 to 8 times in this bull run. Then we look at that, we look at what the bottom was in this cycle. That bottom was a little bit over $1,000. So the upside in this cycle would then project, and these numbers tend to get kind of silly, but we're looking at really $5,000 to $8,000 gold by the time this cycle is over.
One way to invest in the metals, of course, is to own coins and bars and those kinds of things. But you also take a look at the supply chain, if you will, much earlier than that. Talk about the reasons people might consider on the investment side some of the companies that are associated with precious metals.
Yeah, that's a way. Again, if you're investing in gold and you think the macroeconomic environment argues for much higher prices relative to the dollar and other currencies, then you want to look at ways to leverage that. One of the ways that you can do that we specialize in are the mining stocks. And within that sector, there is a pretty broad spectrum from the big major producers further down the food chain to even the explorers and developers. The further down the food chain you get, the higher potential you get, but also the higher risk. So it's an area that is rife with opportunity because it's very inefficient. There are a lot of opportunities that get passed over temporarily by the market that you can find. You can find companies that subsequently make a big discovery and it can be very rewarding. But it is a sector you need to educate yourself in before you dive into it. You need to go to conferences, subscribe to newsletters, talk to companies. And there are a lot of ways to do that, and it can be a lot of fun. But if you put in the effort, it can be very rewarding.
How about a hand for Brien Lundin, ladies and gentlemen? Now, our next guest also has not stopped coming to the summit since his first time. Let's say hi to Dana Samuelson, ladies and gentlemen. Dana, you are a precious metals dealer, so you help people actually buy the gold and the silver, but at the same time, you help us understand broader picture economics. Give us some of the high notes about what you shared with the audience this week.
Well, thanks, Robert. It's been great to be on my 8th summit. So gold is fundamentally over the last 20 years been tracking the debt higher. That's one of the things that Brien helped me understand. Our debt just keeps going higher and higher, and it's going higher faster now. And not only that, we have higher interest rates, so the cost of servicing the debt is increasing, which is creating a bit of a debt-death spiral that we haven't really hit critical mass yet, but it's speeding up. We're at 35 trillion. 10 years ago, we were at 17 trillion. 10 years before that, we were at about 7 trillion. So we're doubling our debt every 10 years now. And what's that going to mean for 10 years from now? We're going to be at $70 trillion in debt? Who knows? So that's one factor. Another factor is we've had some strife in the world. We've got 2 wars going on, and gold tends to climb a wall of worry. That's one of the reasons that's helped to buoy the gold price to new all-time highs. And then you have the economic picture. Peter Schiff spoke earlier about the government creating an inflationary problem that's probably going to persist. And what happens if they decide to turn the printing presses back on with QE? Well, that'll give gold a very substantial tailwind, in my opinion, and a lot of other people's opinions. And central bank buying, as Brien talked about, has just been on a record clip since the great financial crisis. Central banks have been buying on average about 500 tons of gold a year, which is unusual. And in the last 2 years, since the weaponization of the dollar following the Russian invasion of the Ukraine, central banks have been buying double that because they want to get out of the dollar due to the de-dollarization movement, but they can't. It's entrenched in the system, but they can buy gold just as fast as they'd like to, and they have been. And this is a game changer, in my opinion. I agree with Brien. The physical demand is really material at this point in time, and it shows no point in stopping. So I see gold going higher, but it's going to go in fits and starts, and we're in one of those consolidation phases right now where it's going to channel sideways for a little while.
Now, we've been talking up till now really about gold, but gold also has its brother or sister or cousin, silver, and silver can be a great way for folks to get started investing in the metals. Talk about silver right now.
Yeah, I actually think silver's a better value at this point in time. If you look at the previous market highs in 2011 when gold hit $1,900 an ounce, it's about 12 to 15% higher today. At that time, silver was about $48 an ounce, and today it's a little under $30. So silver is about 30% below its previous all-time high, while gold is 12 to 15% above its previous all-time high. So I think silver's a better fundamental value. It tends to lag gold, but then when it plays catch-up, it can play catch-up with a vengeance. And we've seen that a couple times over the years. When COVID broke out and gold went from 1,600 to 2,070, silver resisted that run and then finally got over about 19 and went to 29 on a bullet. And just in this last phase where gold has gone from 2,050 to 2,400, silver resisted that at first at about $23 and then it went to 32. Now it's consolidating right now a little lower, but I think at this price gold, silver should be $35, $40, $45 an ounce. So I think there's a lot of opportunity in the silver market right now.
So you've been coming all these years, and many folks come to the summit and they get their first exposure to investing in precious metal. Is there any time over the last 8 years that people who came on the summit should have not bought gold or silver?
Really? No.
Always been the case. I'm not saying it always will be. So don't go out and buy a bunch and then it goes down to 2,200, but we just never know. Final question, Dana. You keep coming back to this thing. Share the magic of the summit.
Oh, there's no comparing this event to going to a 3-4 day conference. You get a chance to really bond and meet people, build true relationships. I've got to spend some real quality time with some people I have never met before, of course, the attendees. I got to meet Jason Hartman, spend some quality time with Jason here, also with Tom Wheelwright, Ken McElroy, got to spend a little bit of time with Brent Johnson, and of course the attendees. There's so much talent and genuine generosity and spirit in the audience. I call it the most unassuming group of overachievers I've ever met, and it just continues to live up to that reputation. And of course, you're the leader of this whole tribe, and you're doing a wonderful job. So I'm just happy to be here with everybody. It's inspiring. I always walk off the boat with a spring in my step.
There's Dana Samuelson, ladies and gentlemen. Let's give him a hand. Well, it has been an extraordinary week, plus so much that it had to roll over into 2 radio shows. Next week, a completely different show, but also next week, we'll be opening up the next Investors Summit to folks who didn't come this year. These folks have grabbed a lot of the spots, but we'll make room for you if you want to join us in the 23rd Annual Investors Summit at Sea. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys radio show.